All right, welcome to week 2 of financial accounting. So the first thing we're going to talk about this week is what is the role of accounting? And I don't think it's an overstatement to think about accounting playing a very crucial role in our society. The role of accounting has many facets, but one of the most important facets is to create information that allows key stakeholders to rely upon reports that are prepared by the management of those organizations. And so some of the key stakeholders of organizations include people who invest in that by buying stock, people who loan organizations money, their banks and other creditors, people who go to work there, employees and managers, the government, and others. And financial statements are key because they give us one of the key indicators as to what's going on and what the results are of that particular organization. So we'll talk more about the financial reports themselves, but at this point, we just want to think about accounting overall and its essential role in giving us a picture that we can rely upon about an organization, one aspect of that organization in particular, the financial aspect. So when we talk about who are the financial statements prepared for, we're talking about the key stakeholders. So the key stakeholders include the investors. The investors are the creditors, or the people that risk their capital to buy a share of the company. It's the creditors, the people, the organization that loan their money to a company, banks and other institutions that loan money to organizations. It's also employees that go to work there, employees and managers that go to work there. They're key stakeholders. And there's an assortment of external users, the government, investment firms, and the like that we're preparing financial statements for. And we're going to call these people the stakeholders. So the next question is, how much can you learn about a company by understanding its financial statements? So I think the best answer to that is we can learn a lot, but not everything. We can learn about the financial performance of the company, which is one of the key indicators of how an organization, whether it be a for-profit or non-profit organization, is doing. So when we talk about financial statements, which we will talk about over the upcoming weeks, not this week, but starting in week 3, we're going to talk about looking at the income statement, which I had you prepare a very simple income statement for yourself. We're going to talk about something called the balance sheet, which is the things that will let us know what a company owes and what it owns, and other key things. So we can learn a lot by reading and understanding the financial statements. It's certainly any key stakeholder wants to be able to find and read the financial statements of the organization that will give us some key insight. So one of the important things when we talk about financial statements and financial data coming from company is how can we rely upon it as being fair and accurate? So what we'll come to learn as we go through the semester is that there are checks and balances in place. Those checks and balances, sometimes called the Certified Public Accountant or the CPA, sometimes called the Securities Exchange Commission or the SEC, sometimes called the credit rating agencies like Moody's or Standard & Poor's. There's a variety of organizations who look at the financial statements and review them and make sure that what management has prepared and what management's responsible for has been done accurately and fairly so that the rest of us and key stakeholders can rely upon them. And without that assurance, without that independent check and balance, then this system would not work. So sometimes things break down. So at some point during the semester, I'm going to have you take a look at what happened to a very large and famous company by the name of Enron. In 2001, they were a Fortune 100 company, one of the largest companies in the United States and the world. And unfortunately, despite the checks and balances, the system did not work in their particular case. So sometimes people can work around the system. And when they do, the outcomes can be devastating for investors and creditors. It's estimated that organizations and people lost up to $50 billion, sometimes their entire life savings, sometimes their retirement funds, because they relied upon the financial statements that were prepared and attested to, but unfortunately, the system failed them in that particular case. So we've tried to put some extra checks and balances in place since 2001. Hopefully they'll work, and hopefully when we review the financial statements of a company, we can rely upon them as being accurate and fair. So one of the key terms that we'll talk about throughout the semester is this idea of full disclosure. And essentially what full disclosure means is that management has a legal and ethical obligation to disclose any information that they know which may influence the decision-making of the key stakeholders, in particular the investors and creditors. So if I know that something is going to adversely impact my company or organization, and it's not in the public domain, and that may in turn influence the decision-making of people who invest in my company, who people loan money to my company, or people who want to go to work at my company, I have both a legal and ethical obligation to provide that information. And there are forms that the Securities and Exchange Commission provides for companies to communicate that information. So the other thing that we'll become familiar with is this term GAAP, G-A-A-P. It stands for Generally Accepted Accounting Principles. And these principles are the basis by which financial statements and reports are prepared. And we need a set of principles so that when I pick up the financial statements of one organization and I compare it to another, I know that they're using the same set of rules. And those same set of rules are called Generally Accepted Accounting Principles. So I mentioned briefly that we need checks and balances. The CPA is at the leading edge of the check and balance. The CPA is an independent accountant or accounting firm. Their role is to go into a publicly traded company, review the financial statements that are prepared by management, and attest that they were prepared in accordance with generally accepted accounting principles, and they fairly and objectively represent the financial results of the company. And so a CPA plays a very integral role in this whole checks and balance. And the SEC stands for the Securities and Exchange Commission. Their role is also integral. They are the federal agency that's responsible for implementing the Securities Exchange Acts of 1933 and 1934, which places requirements on publicly traded companies that sell stock to investors, requires them to publish their annual financial reports, requires them to provide full disclosure, requires other information that's integral to the financial statements. And they also play a role in determining the generally accepted accounting principles. They play a role in reviewing financial statements as prepared by companies and other key roles. So they're another check and balance in the process. There are other players in the checks and balance process, but we're just going to talk about the Securities and Exchange Commission and CPA during Chapter 1 discussions. So a couple of things I'd like you to think about as you complete your activities this week and over the upcoming weeks is what companies or organizations you'd like to work for after graduation, and how helpful it would be for you to start to be able to read and understand the financial statements of those particular companies. So, and that's what I'm going to try to take when we pick individual organizations to review the financial statements, I'm going to try to align it with your interests. So we're going to be talking this week about what is financial accounting, who cares or who should care, and why is it important. And so I want to just focus this conversation why accounting matters to you and should matter to others. So it allows us to make rational decisions. And so when we talk about rational decisions, we talk about decisions about whether I want to invest in a company, whether I want to loan money to a company, whether I want to go to work for a company or stay working for a company. So the financial information gives us some information to evaluate the organization and to understand the estimates, the nuances of the financial numbers. So I know that, where there might be some opportunity for some adjustments. And it also helps us to get a sense of the overall results of a company. So the next question is, what is accounting? So accounting, while I hope I've established that accounting plays an integral role in our society, we should talk about what it actually is. So it's often called the language of business. It's called the language of business because one of the main things that businesses and nonprofits communicate to their stakeholders are the financial results. And they do that through accounting reports. We call them financial statements, using a set of rules, which we call generally accepted accounting principles. And so accounting is really gives us that framework, those set of rules and those tools to be able to communicate that information. So it enables the organization to communicate, and it allows us to have a set terminology, structures, and principles so that we know what we're looking at when we pick up financial reports. So chapter 1 talks about the process of accounting. So we go through a certain set of steps. We have to identify, measure, and communicate economic information about the entity so that we can make better decisions and informed judgments. And when we talk about the importance of accounting, we talk about things that are relevant, reliable, and comparable. Again, to help people make better decisions. So we know we're not going to be able to, with 100% precision, capture every transaction and every detail, but we want to make sure that what's significant, what's important, is identified and recorded. So what happens in companies is that there are transactions. Every day in a company or a nonprofit organization, transactions go on. Somebody buys something, somebody sells something, somebody moves inventory from the warehouse to a customer, people spend money on electricity, on payroll, etc. So there's all sets of transactions going on. Those have to be recorded, and that's what accounting people do. They record those transactions, and then they figure out where they belong, what financial statements or what reports they belong on. They belong on the balance sheet, the income statement, statement of cash flow. And we haven't got that far yet, so don't worry about the details of any of this, but just understand conceptually what's going on there. And then we have auditors, which we call CPAs, attesting that management has a system of internal control, that these financial statements are done in accordance with generally accepted accounting principles, done fairly and ethically, and then so that key stakeholders, managers, investors, customers, suppliers, unions, regulators can rely upon the financial statements and the financial reports that management is preparing and presenting. So to summarize, financial accounting refers to the process that results in the preparation and reporting of financial statements for an entity. And it's primarily focused on externally oriented stakeholders and the historical results of the company. So I'm going to tell you how we did last month, last quarter, last year. I'm not going to make projections about the future. That's a different realm, and that's really not the realm of financial accounting.